Hello, this is Mike Swanson of WallStreetWindow.com. I hope you're having a nice Labor Day. The stock market is closed today, although the crypto market is open and down again, as it often is over the weekends. But other than that, not much is going on, and that's nice. It's nice to have these days in which you can just look at the markets without them trading. And they're also good times to kind of step back and look at your own results, see if you need to make any changes uh, going forward. And I want to talk with you today about what's working in the markets. I put on two trades that I talked about in these YouTube videos last month in August, and they're still working. And I want to talk about those trades with you, show them to you, and why they're working, because that's significant no matter what you're doing in these markets. Let me load up the first one, and it's Tesla. Now, Tesla is a stock that has become perhaps the most popular stock now to trade in the stock market among small and individual traders. Almost every single day, trading in Tesla ranks as the most traded stock and even ETF among Fidelity account holders. They have data that they put out live showing you the most bought and sold positions, trades being done that day. And Tesla is usually in the top three among the most owned stocks among Robinhood traders. Well, I actually shorted Tesla last month indirectly. I didn't. I bought an ETF that is designed to go up when Tesla stock goes down. Now, what happened with Tesla is it rallied in August up to 310, and then it ran out of steam, just as the S&P 500 and the NASDAQ ran out of steam. And just like the S&P 500 did, what Tesla did was rally up to the 200-day moving average on its own chart. That's the green line here. And once it did that, it basically went into a sideways trading range for almost an entire month, trading with resistance at 310, support at 280. And while it did that, and I talked about all this in two videos I did about Tesla in August and this trade, in fact. But as this happened, the Bollinger Bands indicator on this Tesla chart, that's the pink lines overlaying the candlestick chart, they started to come together. And that caused the wick indicator to go down below 10. And that was the lowest level it had been at, in fact, all year. What does that matter and what does it mean? Well, this is a useful indicator to use if you want to time trades, which is what I was exactly using it for with Tesla stock. You see, what the indicator does is it comes together when the volatility over, in this case, a 20-day period of time, and I also use longer term indicators, but in this case, a 20-day period of time. Now, that tends to happen after the stock has made a big move, and then it enters a pause period before another big move happens. The indicator doesn't tell you in which direction that move will be in, but it tells you that one is imminent, and that becomes a signal to place a trade on a short-term basis. And that's exactly what I did. The indicator fell below 10, the lowest level all year, telling me, and I was telling you in a YouTube video I did about it 2 weeks ago, look, a big move in Tesla is about to start. Not one that's just going to last a day or 2 days, but one that's going to last a couple of weeks. If Tesla was to break to the upside by closing 300 above 310, we likely would have seen a rally back up to the April highs. That represents a 70-point move, an almost 20% return in Tesla stock. But that did not happen. Instead, the stock broke down. It broke support by closing below 280. That therefore signifies that we are likely in a new downtrend in the stock, likely to take it to at least below 210. And that's why I shorted the stock through an ETF. The one I used is TSLS, and I talked about it in a video 2 weeks ago. So the trade is now working. We're below 280, and that's good. Now, the second trade I talked about was before that one, early in August, and it was to purchase an exchange traded fund, TBT, and place a stop loss order if it fell below the 150-day moving average. Now, I talked about it in a video during the period of time that I circled it on this chart. The trade is working out because ever since that week, this ETF has trended up. It's gone up to closed right below 28 on Friday. So that's an over 15% return already in this exchange traded fund. Now, you may say, look at this and think, well, this is kind of the opposite of the Tesla trade. Instead of watching something go up to the 200-day moving average and stall out, in this case, we were using the 150-day moving average as support. So in a bull market in something, which happens when the stock, the exchange traded fund, the sector you're watching, is trading above the 150-day moving average, 200-day moving average, which this has been doing, those levels tend to act as support. You typically will see a pullback to them once or twice a year. In a bear market, they act as resistance, but they're acting as support in the case of this exchange traded fund. So in essence, I used the dip towards the 150-day moving average as an entry point. Now, what is this exchange traded fund? That's the secret. This fund is also a short ETF, but in this case, it trades opposite to TLT, which tracks the 20-year Treasury bond. And as you can see, we got a rally or a bounce in this exchange traded fund that coincided with the dip in TBT. From June to the start of August, this exchange traded fund bounced. It didn't get exactly to the 150-day and 200-day moving averages, but it bounced. It bounced enough that the daily stochastics got overbought, and so as you can see, the TBT trades opposite this. This got overbought. It's been trending down ever since, and it's near a low. Now, this exchange traded fund, as I said, owns 20-year Treasury bonds. 20-year bonds tend to trade opposite to, or they do, to what they yield. So when the yields go up in bonds, the bonds go down in value. When yields go down, bonds go up in value. Now, there was a lot of talk. As you can see, this is the 10-year yield. It made a short-term peak in June, pulled back into August, pulled back into the exact peak in TLT, which I used as a short entry point. Now, I want you to step back and remember what we were hearing 6 weeks ago from gurus, such as Cathie Wood, from so many people on CNBC. They were claiming, oh, because the yields are going down, the Federal Reserve is going to pivot. They're going to stop raising interest rates. So they're going to maybe even reduce the interest rate, which would help the stock market go up. That type of talk encouraged millions of people to play the rally, to buy stocks, and even to get into meme stocks, to think that the stock market, bear market, was over because these yields had pulled back and the gurus came out making these predictions. The problem with all what they were saying, though, is they were looking at a mere short-term move on the chart, a move that wasn't even capable of breaking the underlying trend, a move that didn't even take the bond funds above their 150-day and 200-day moving averages. They continue to act as support. The move was a counter trend, short-term rally within a long-term bear market. The thing about the yields in these treasury bonds, and they are been going up since 2020. Remember, when the Federal Reserve lowered rates to zero, uh, that was the lowest yield on treasury bonds ever in the history of the United States. And there was nowhere to go but up from there once they got to zero for the yields to go up. So bond funds reached an epic value in their price as the yields went to zero, levels that we will never see ever again in our lifetime. And, so we're in a secular bear market in bonds, a secular bull market in yields. So again, all the excitement that we saw in June and July from the gurus about the yields going down, they were focused on a very small gyration on this chart that was completely meaningless in the big picture. And that's why the trade I did, shorting the bonds, worked out. Buying TBD worked out because it was a trade in which I aligned myself with the secular long-term trend using a short-term pullback to get in. That's what trading is about. It's not looking at what the market does every single day, or or on the hour, or listening to someone get all excited about a short-term move, the market's one way or the other, and jumping on that. It's about aligning yourself with the real trends that are underlying the market, that have been going on for months. They're slow trends, then they change slowly. And that's also why the trade in Tesla has worked out so far. Because you see, when we look at the S&P 500 here, we can see that what happened with it, it also rallied up to the 200-day moving average. It did close above the red line, the 150-day moving average, for 3 days in August, but not once did it close above the green line, the 200-day moving average. And what happened? We popped above 4,100 in August, got up to 4,300. It was during that 200-point rally that all the excitement appeared again in the meme stocks, and some doubled in a couple of days, and then they crashed. And that brought traders in the market trying to get back into that, but the rally stalled out. In fact, now when we look at what happened in August, looks very similar to the peak in the S&P 500 in April, very similar to the peak also made around New Year's. And after both of those peaks, the market went down. And ever since then, the market has been also going down once again. In fact, this time, the VIX fell below 20 and stayed about below that for about a week, showing that when it comes to the so-called fear gauge, which measures the volatility people are paying for put premiums, much of which is used to hedge positions instead of sell. So people, when they get scared, they scramble to buy puts to hedge, driving up the premiums. And when they're not scared, they don't do put buying, and the premiums shrink and collapse. And that's what they did. They shrunk and collapsed in August, getting about to a low not seen since April. So all the fear came out of the market, and now we're back into the bear trend going down, which we've been in since January. We've been in a bear market since January. And when you're a bear market, the thing to do is use rallies to sell, raise cash, be cautious. And if you want to be aggressive, which is what I did with the Tesla short, you use the rallies to bet against a few stocks. It's very difficult to take on massive short positions because it's harder to go short than it is to go long. That's why I prefer to go long than to go short. When you're right buying a stock, it can double or triple. When you're right going short, you're making 20, you're making 1%. So you're kind of risking almost the same amount that you put in. The payoffs are much bigger when you're right being long, but when you're long or trying to trade meme stocks in a bear market, you can lose money so quickly that by the time the bear market is over, you're so shaken up mentally that you can't buy, or you don't have the money to do much buying. And I want you to be one of the people buying when this is over, because that's when the greatest buying and investing times come, period. So that's what I want to talk with you today, this Labor Day. 2 trades I did in August, but more important than like, it's not about bragging about the trades that work, but more about why are they working and what can we learn from that. With Tesla, those Bollinger Bands make for good trading entry points, whether you're trading long or short, to try to, get in time things before a jump up or drop down that's meaningful happens. So it worked with Tesla, and I'm sure it's a tool we'll someday use again in another trading situation. That's what they do. They spot trading situations. So, I do videos about all sorts of stuff: news, economics, real estate, and trading. If you want more trading videos from me, hit like so I'll know that that's what you want to see. And if you're new to me on YouTube, get my next video update by hitting the subscribe button and hitting the bell next to it, and YouTube will send that alert to you.